Time now for Options Corner. I want to bring in Rick Ducat, lead market technician, and take a deeper look at Cisco. So when you look at Cisco, what are the trends that you're noticing, Rick?
Yeah, so it's been a nice move for this big tech company here. You can see that we did hit those 52-week lows near 44.50, a sharp rally from that point that is somewhat moderated now. We've seen the trend break through that purple line and transition into more of a modestly sloping white upward channel type shape here. However, we are quite close to those highs. We are hanging on above that previous high that we established here near 62.32. There is a small volume node developing, so there is some trading here. If we keep moving to the upside, 64.40 is our +1 standard deviation channel. To the downside, a confluence of some technical indicators and our old trend line and a volume node around 59 or so, Diane.
Now, I know you often, take a look at the options activity, look for any patterns there. What did you notice in terms of any options activity in Cisco's from yesterday, Rick?
So we do have earnings coming up, but the most important expiration in terms of open interest by far was March 21st here. And you can see here the top two for both sides, the calls and puts, 60 and 55. So those could be some important strikes to keep in mind here as we go forward. Biggest single trade was a trader bought the February 21st 62.5 calls. It was a $288,000 debit bullish trade.
All right, Rick Ducat with the options activity and the chart for Cisco. Time now to go through an example trade. Joining us for that, we've got Tom White, co-host of Fast Market and senior options contributor. All right, we've got earnings in front of us for Cisco. So that, to me, begs the question, how would you structure an example trade, especially when you think about, say, timing for it?
Well, you start looking at implied volatility levels here, Diane, going into this report. Volatility elevated going into the report. The option market's pricing in about a plus or minus 5% move in the shares, about $3. Now, the stock's up about 24% from year ago levels. So you have to take that into consideration. Just near 3-year highs in the shares in this legacy stock player. AI is going to be a big component within these results. So I looked at really short-term strategy. If you think this thing's going to continue to move to the upside on a good report, this type of strategy takes advantage of it. Really short-term positioning. Going out to the February 21st monthly cycle that expires in 9 days, we're going to buy basically the at-the-money 61 strike call. And then against that, in the near-term February 14th weekly options that expire in just a couple days, we're going to sell the 65 strike call to take advantage of those higher implied volatility levels. So $4 wide, bullish, call diagonal to the upside. You're going to pay roughly about $1.50 debit for that spread. That's your risk. Also $150 per spread on this one, with the expectations that it's going to move up towards the 65 level, which would be about that 1 standard deviation move that the option market's pricing in. Your break-even is going to be around the $62 level, so anything above there is going to be profitability. The key with this type of strategy, Diane, is the fact that you're buying a lower implied volatility, about 50% on aggregate in that February 21st monthly cycle that you're buying the 61 call, and selling over an 80% implied volatility on those February 14th 65 strike calls. So this takes advantage of a move higher, takes advantage of that dispersion between implied volatility levels in the shares also on this one. So if you think it's going to move higher, this is the type of strategy that takes advantage of it. Really short-term positioning. As you get closer to expiration over the next couple of days, you'll have that ability to roll or adjust that short 65 strike that you sold in the near-term options. But this might be the way to play it if you think the stock is going to move to the upside.
If you think it's going to move to the upside, but if it, say, moves sharply above 65 before that February 14th expiration, how do you manage it?
Well, that's actually a bonus, right? Because anything above about the 62 level is going to be profitability. Because you're paying less than the width, the $4 width of this call diagonal, you're only paying $1.50, so less than half the width of it. So anything above the 62 level is going to be profitability on this one. But it allows you to do some adjustments or close the trade if it does move in the direction that you want it to, which is at or near that 65 level.
All right, that's an example trade for Cisco with earnings coming up. Thanks a ton, Tom.